tax season. I mean, just hearing those two words can literally send a shiver down your spine, right? It's a time of year that brings up, well, a whole lot of anxiety for a lot of us. But what if we didn't actually need to be terrified of the IRS? Hey everyone, and welcome. In this explainer, we're going to transform that annual dread into total confidence by breaking down IRS audit red flags and reporting accuracy. We're going to dive into what actually triggers these reviews, and much more importantly, how we can set ourselves up for complete success.
So think about this for a second. What if one tiny, simple mistake on your tax return led to literally months of IRS letters? Yeah, it's a terrifying thought. You hit submit on your return, you think you're totally done for the year, and then boom. Weeks later, you check your mail only to find yourself buried under document requests or worse, facing a full-blown audit. Now, while most tax returns actually never get audited, certain mistakes and kind of unusual patterns can massively increase your chances of attracting that unwanted IRS attention.
But hey, before the panic sets in, let's just take a collective deep breath and look at what an audit actually is. An IRS audit is really just a review of your tax return to verify that your income, deductions, and credits are accurate. Honestly, that's it. It doesn't automatically mean you've done something illegal or shady. You gotta think of it less like a criminal investigation and more like, a routine fact check. Sure, some returns are picked totally at random, but a lot of them are triggered just because something didn't quite match the IRS records, or maybe it looked a little unusual compared to other taxpayers. The great news here, most of these audit risks can be completely eliminated just by filing carefully and keeping solid records.
Okay, so here's our roadmap for today's explainer. First, we'll look at the income mismatch trap. Second, documenting deductions and credits. Third, separating business and personal. And fourth, avoiding simple tax mistakes. All right, let's jump right into part one, the income mismatch trap, and why matching your forms to IRS records is absolutely crucial. It is honestly kind of mind-blowing when you realize the sheer volume of data the IRS already has on you before you even sit down to file. I mean, they receive copies of almost everything. We're talking your W-2 wages, 1099 NECs for any freelance work, 1099Ks from payment apps, INTs for interest, DIVs for dividends, the whole shebang. And their automated computer systems, they are incredibly efficient, like lightning fast. If your tax return leaves out income that they already have a matching form for in their database, those systems are going to spot that mismatch instantly and automatically flag your file. So this brings us to a really crucial role. Report absolutely everything. Look, in today's gig economy, it is so easy to overlook those smaller income streams. Let's say you made a quick $200 selling an old couch online, or you drove a couple of weekends for a rideshare app and just kind of forgot about it. You might think, oh, it's too small to matter, right? Well, actually, if that platform issues a 1099K, the IRS already knows about that money. Even minor side hustle income, freelance gigs, or literally just a few bucks of bank interest, it all needs to be meticulously reported. Honestly, the easiest way to dodge this mismatch trap is just to make sure you've gathered every single tax form before you even start typing numbers in. Moving right along to number 2, documenting deductions and credits, which I like to call the prove it categories. Now, claiming large deductions isn't automatically a bad thing, but they absolutely require a solid paper trail. If you look at some of these bigger deductions, things like major charitable donations, hefty business expenses, a ton of travel, or a dedicated home office, they have to be backed up with the right documentation. You can't just guess. If you're writing off thousands of business miles, you're going to need those donation acknowledgments, detailed business logs, mileage trackers, and actual receipts. The IRS just wants to see that your deduction matches reality, especially if your claims are, way higher than average for your income bracket. Having that good documentation isn't just helpful, it is literally your absolute best defense. And you know what? The exact same logic applies to tax credits. Credits are a huge deal because they directly reduce your tax bill dollar for dollar. It's real money back in your pocket. But because they're so valuable, claiming them without actually meeting the strict eligibility rules will 100% attract IRS attention. We're talking about things like the earned income tax credit, the child tax credit, or education and energy credits. For example, if you claim an education credit but you're not actually a qualifying student anymore, or you try to claim a green energy credit for a quick home fix that doesn't strictly qualify, that will absolutely trigger a review. So always make sure you completely understand the rules and keep those supporting documents handy. All right, that brings us to part 3, separating business and personal, or figuring out exactly where to draw the boundary lines. Look, running a small business is tough, and it definitely involves some inevitable ups and downs. But in the eyes of the IRS, there is a very fine line between a struggling startup and a personal hobby. If you're reporting losses year after year, but you're bringing in almost zero revenue, well, the IRS is going to take notice. They might start poking around, questioning whether this is truly a genuine business endeavor, or if it's really just a personal hobby that you're using to write off expenses and magically reduce your taxable income. So how do you fight that dreaded hobby label? Well, you have to prove that you're operating with the actual intent to make a profit. You have to show them it's a real business. And how exactly do you do that? Simply put, by treating it like one. You need to keep meticulous records of your sales, your marketing campaigns, your official business plans, and all your customer invoices. And this is a big one. Maintain completely separate business bank accounts. When the IRS sees these documents, it speaks volumes. It proves your legitimate intent and shows them, hey, I'm running a serious operation here, not just a weekend pastime. And this strict boundary, it applies directly to your everyday spending too. You can see the contrast here. You've got legitimate business expenses, things like marketing campaigns, buying essential equipment, or paying for bookkeeping software. Those are great, but then you have the major red flags, trying to deduct personal expenses as business costs. I mean, you simply cannot write off your family beach vacation, your everyday dinners out, your standard wardrobe, or regular household bills that have nothing to do with your job. A fantastic, practically foolproof habit is to just strictly use separate business checking accounts and credit cards. When you keep your finances totally isolated like that, tax preparation becomes a breeze, and it fully backs up your deductions if the IRS ever comes knocking. Which leads us to our final section, number 4, avoiding simple tax mistakes, also known as the unforced errors.
It's actually kind of crazy when you think about it, but a ton of audits and IRS notices don't start with some massive Hollywood-style tax fraud. Nope. They start with the incredibly simple mistakes you see right here. We're talking about an incorrect Social Security number, checking the wrong box for your filing status, off by 1 errors on your income amount, basic math miscalculations, or literally just forgetting to attach a required form. When you're rushing at the 11th hour to meet a deadline, it is so easy to make a typo. But that one little unforced error, it can unleash months of administrative headaches and trigger the exact IRS scrutiny we're trying so hard to avoid.
The good news? Preventing these errors is entirely in your hands, and it's super straightforward. Step 1, take a breath and gather every single tax form before you start. Seriously, don't file early if you know you've got another 1099 still floating around in the mail. Step 2, use tax software. It's brilliant at automatically catching a lot of these simple math and matching errors. And step 3, perform a focused 5-minute manual review to double-check everything before you hit that submit button. Think of it as your final line of defense. I promise you that 5-minute review is the highest return on investment you can possibly make to save yourself from months of stressful IRS letters.
So as we pull all these pieces together, the ultimate takeaway is this. Remember, claiming legitimate deductions and credits is perfectly acceptable, as long as you meet the requirements and maintain proper records. I love this because it's such an empowering perspective. You really shouldn't be afraid to claim the money, the credits, and the deductions that you are legally owed. The IRS tax code was written to include these benefits for a reason. Just a little bit of organization and preparation today is going to help you confidently claim what's yours and avoid all that unnecessary panic tomorrow. I want to leave you with one final thought to chew on as we wrap up this explainer. Would your current record keeping survive a 5-minute IRS review? Really, be honest with yourself. If the answer is no, well, now you know exactly what steps you need to take to get there. Get those receipts organized, draw a hard line between those personal and business accounts, and please, take that extra 5 minutes to double-check your forms. By doing all of this, you can actually approach tax season with absolute confidence. All right, keep learning, keep organizing, and I will catch you on the next one.